Coming up today, Nvidia bounces back. Will it continue rallying, or are we on the verge of a bear market? What sectors could outperform next? Oil falls back, and the top 10 reasons why empires fall. Hey, what's up guys? Thanks for tuning in to the daily market review. And a little bit of an opposite of what happened yesterday. Actually got rotation back into large caps, out of small caps today. But overall, pretty flat, quiet day for this Tuesday session. Still got the S&P and NASDAQ underneath the 5-day, with the Russell, energy, healthcare, and high-yield bonds still holding up there in the short term. Volume breadth was a little bit weak on the NYSE, a little bit better on the NASDAQ, and there's that peel back in overall market breadth today. Still got more than half of all stocks above the 20-day average, but once again, we've got more stocks making new lows versus new highs on both the NYSE and NASDAQ. Wasn't enough to upset the volatility market though, VIX pulling back underneath 13. Government bond yields still really subdued here, tracking sideways, 474 on the 2-year. High-yield bonds still holding up really well, along with the dollar, and a bit of a bounce back for Bitcoin as well, after yesterday's sharp sell-off late in the session. Gold, similar to bonds, just tracking sideways, and a little bit of a retracement there for crude. Looking at the largest stocks in the market, Apple really quiet, Microsoft still pressing up against all-time highs, and a bit of a good bounce back there for Nvidia, up 6.7% today. Starting to get a bit volatile here, and one could argue that's kind of the price action of a bear market rally. So like I've been saying, we very well could come up and test this big bearish engulfing candle. Still yet to be seen whether that holds, or who knows, it may take it out and just keep charging higher. Go into a real parabolic melt up, and a lot of people did buy the dip. I was seeing it all across my social feeds as well. Yesterday, people calling for Nvidia being oversold. Good opportunity to get in. Didn't really knock the market over by having their sharp pullback either. It's a big volume coming into these leverage Nvidia ETFs. And overall daily retail inflow spiking up this last month in Nvidia. Huge amount of trading volume and activity, which again is typically associated with tops and bottom. And there's these Nvidia leveraged ETFs. There's the 2 times long, huge volume, 25 million units traded. And you can just see that pickup in volume even though prices increased. And the other most popular one, the Nvidia 1.25x leveraged bear ETF. Again, a lot of volume this last couple of weeks, as this is by far the most hotly traded asset in the world, with option volumes still exceeding that of the S&P 500 and by more than triple as well. And overall, the options market, 58% calls, still really lopsided here. And there's still plenty of bulls out there. In fact, Constellation Research has given 7 reasons why Nvidia is poised to soar 67%, as they think its rally will continue for another 2 years. With the first reason being, as a visionary founder-led CEO, high barrier to entry, high switching costs, dominant market share, strong product roadmap, GPU is a default standard in AI, and the numbers don't lie. And all of that is true. However, you could have made the same argument about Cisco in early 2000 as well. Nobody knows what the future holds, but one thing you can bet on is that the only constant is change. Things rarely stay the same way for long periods of time. But for the here and now, Nvidia do have great numbers, great growth, and that's why their forward PE is even lower than some of the peaks it's been at the last couple of years. Currently at 41, which is well below where Cisco got back in early 2000, up to 130. In fact, Nvidia itself back then sporting forward PEs around 70. On the other side of the coin, we've got Charles Schwab saying stocks are looking eerily similar to the last bear market crash, as there's a growing divergence between index level and individual stock performance. A lot of dispersion, and it's true, we can see that in a long-term monthly chart of the implied correlation index, currently below 8%, which is pretty much as low as it's been looking back in history. And that's basically the opposite of hard times. You look at market crashes, bear markets, sharp sell-offs, the sell button gets hit on everything, big liquidity drain, and correlations move closer to 100%, especially in COVID. Everything was getting sold off. And we are truly witnessing history right in front of our eyes. US stock market concentration, Magnificent 7. Mega cap tech stocks coming out of the US, now worth more than any non-US national market. Combined market cap 15.7 trillion, bigger than the entire Chinese stock market, 8.7 trillion. Japan, India, and look at Germany, 2.4 trillion. Europe's biggest economy. What has happened over there for the last 20 years might have something to do with their leadership. And again, this has happened before. Some of you watching may even have been around 50 years ago, in the late 60s, going in the early 70s. The nifty 50. Stocks like Kodak, Polaroid, Xerox, IBM, McDonald's, Johnson & Johnson. They had a lot of names. The Vestal Virgins, Sacred Cows, religion stocks. And these companies had an amazing ability to deliver above average growth in sales and earnings. In fact, by early 1973, the median stock on the NYSE was trading at a multiple of 11.5 times earnings, while the average price earnings ratio for those top 50 stocks was around 48. And they just kept grinding higher and higher, and the list of outperformers got narrower and narrower. However, like all good things, it came to an end. Stock market eventually sold off, and the Nifty 50 as a group declined by about 60%. And there's a long-term chart of the top 40 stocks as a percentage of the S&P 500 market cap, currently around 56%, similar level to the late 90s, and back in the early 70s, that was actually higher, thanks to those Nifty 50. But of course, a decade of inflation cut them down to size, and as much as that repeat of history seems inevitable, for the here and now, we're still on this low volatility, grinding higher environment. 337 trading days since we've seen a 2% drop in the S&P 500. That's the longest since 2017, and looking back in history, this can go on for some time. So a really low volatility period in 2005, and similar periods of low volatility in the late 60s, early 70s, back when we had the Nifty 50. However, in the short term, like I've been saying, we may have got a little bit ahead of ourselves, a bit too far ahead of seasonality. And looking out over the next month, got a large percentage of S&P 500 companies going into a blackout period for buybacks ahead of Q2 earnings season, which they won't be buying back any of their stock, which is a big material driver of stock prices. But that may not matter all that much, as the narrative on the street is inflation is slowing, a recession has been dodged, and stocks are set for a summer stunner. And it's true, the stock market could have a ways to go before we hit those really bubbly peaks. Just looking at some data, S&P typically peaks when quality and momentum are outperforming versus history and valuation is elevated. Combining all that together into a signal triggered when it goes above zero, we're not quite there yet. However, looking back in history, when we do go there, quite often, a bear market is just around the corner. And just looking at the SARM rule, which is just as good as measure of predicting a recession, as is an inverted bond yield curve, basically when the 3-month average unemployment rate minus the minimum unemployment rate over the trailing 12 months, when that goes above 0.35%, that triggers a SARM rule, and typically a recession is just around the corner. Again, we're not quite there yet, but we're getting awfully close. So we'll be keenly watching what the unemployment rate comes in next Friday. If that ticks up to 4.1, 4.2, that's going to trigger some of these indicators like the SARM rule. And just keep in mind, after the first Fed cut, typically you'll see value do better than growth right away. However, looking 6 months, 12 months out in history, after the first Fed cut, which they very well could do this September, especially if we get unemployment come in at 4.1, 4.2, along with CPI come in as expected or even softer, small caps significantly outperform large caps in the 12 months. Following the first Fed rate cut, doing even better than stocks, of course, is bonds. As yields come down, bond prices go up. But like we can see, before a rate cut going into it, small caps underperform large caps, just as they have been this last year and beyond as well. Looking underneath the hood further of what sectors outperform the S&P before and after the first cut, looking 12 months out, the best sectors are materials, real estate, and utilities. In the year following a rate cut, they're more likely to outperform the S&P. Surprisingly, healthcare does not. And so we kind of got Treasury bond yields on standby here, waiting for personal consumption expenditures PCE data this Friday, in which each new economic print we get now is carrying more weight than the last, as it's really getting down to the wire of whether Jay Powell's going to cut rates or not. And who knows, he may just cut next month, as cutting in the last meeting before the federal election, whether he likes it or not, is going to look really politically driven, even if it were actually justified. But he's got to also have his eye on oil, which has been firm of late, bouncing back in defiance of the Biden administration, which also mustn't be too happy with the price of oil and the retail price of $4 a gallon going into the summer driving season. And this is when crude oil in the Strategic Petroleum Reserve, which was first set up back in the early 70s thanks to the oil embargo, US needing a strategic reserve in times of war or emergencies. Biden administration's already released a ton of oil out of that to try and keep a lid on oil, and has threatened to release more. It's currently down at the same levels from 1983. However, crude oil futures seem to be acting in defiance of that and sitting pretty above $80 a barrel. And so if you're wondering, are we just stuck with inflation? There's nothing no one can really do. It's that supply side constraints or Vladimir Putin or some other boogeyman creating it. Well, the answer is no. And we can see how much of a dramatic and fast effect just having the right leadership can do to inflation. Argentina, struggling with high inflation for decades under socialist governments who become really bloated, corrupt, overspent, lots of debt, creating inflation out the wazoo. In comes Javier Milei, drastically cut government spending, cleaned up the government, got the country back on the right track, and now they just recorded their first week without inflation in 30 years, just only 6 months in on the job. And so what will happen to inflation if Trump gets back into office? Could have a big effect on all of us, financial markets. Well, according to 16 Nobel Prize-winning economists, they're warning a second Trump term would reignite inflation, pointing to the same policies he implemented in his first term. tax cuts, opposing tariffs from China. However, these same economists signed a letter in favor of Biden's spending policies, which, like The Economist, a politically neutral magazine that looks at the data, has actually pointed for being responsible for the high inflation. And again, just looking at the numbers from the Bureau of Labor Statistics, out of the last 8 presidents, Trump actually had the lowest overall inflation at 4.1%, and Biden at 15% is only second to Jimmy Carter for having the worst inflation in modern time. And so there's widespread concern, myself included, that America is at risk of entering into the late stage of an empire with the wrong leadership. And I've studied the fall of various empires, from the Romans, Ottoman, Spanish, British, you name it. And I think many will be surprised that there's common reasons for the fall of all of them. And just looking at the top 10 reasons why empires fall, first being political corruption, self-enrichment, and persecuting opponents. Saw that in the Roman Empire, created a real elite class at the top, throwing political opponents in jail. Number 2, overextending military, waging endless wars around the world. It's very rare a country can successfully take over another country or change it for the long term. It's quite often a waste of life and money. We saw that with Afghanistan. United States taxpayer spent $3 trillion over 20 years to try and replace the Taliban, only to leave in the most messy of ways, handing all the power back to the Taliban, pretty much achieving nothing. High taxation creates an unproductive economy. Governments are notoriously bad for spending money, being good stewards of capital. They have no competition, no incentive for profit, bogged down by bureaucracy, and so the more the tax there is, the more inefficiencies there are in an economy. And from all that tax, spending too much money, again, creates a lot of inefficiencies. Private sector is much better at handling capital, spending, projects, being accountable. Excessive public debt, living above production. Just like any of us, if we borrow too much, we'll eventually drown in that debt. But unlike us, governments can artificially print money. I think a lot of people will be surprised the Romans printed money. Classic sign of a late stage empire, which of course leads to inflation, which then leads to currency devaluation. Seen that currently in Japan. Too much debt and can also be caused from too much inflation. An important one, I think a lot of people underestimate, loss of cultural values. Weakening of our foundations. Much of the West was built on European, Christian and Catholic values, and there seems to be a conscious and consistent pursuit for the desecration of those values, which, like wealth inequality, again we saw in the Roman Empire, a real elite class at the top, doing really well, taxing the heck out of everyone below them, causes a lot of social unrest, and potentially civil wars, internal power struggles from the lack of unity. And so I'll leave it up to you to decide which leader is more likely to contribute to these top 10 reasons for potential downfall of the American empire. Moving on to the economic calendar, we've got inflation data come out from Canada. A little bit hotter than expected, 2.9% year over year versus 2.6%. Home prices in America still climbing, 7.2% year over year. Just like the stock market, there's some worrying signs, but still overall holding up. CB consumer confidence, a little better than expected. Looking out till tomorrow, we got new home sales, crude and gas stocks, and then Thursday we'll get to see how the US economy is growing in Q1, and then Friday, the important one, PCE inflation data. Fed fund futures, still pretty much unchanged there. 2/3 chance we cut in September. And corporate insiders tapering off their trading, which you'll often see going into corporate buyback blackout periods as well. Not to mention summer, which can often lead to lower trading and activity as well. Worst performing sector today, home builders, down 2.8%. Gold miners still a little soft there. There's a spread between small caps and large caps, pulling back a little bit there today. We've still got this weakness in the global commodity growth spread, copper versus gold. Inflation expectations, still on a short-term downtrend, but high yield bonds versus treasuries, I think one could still say we're in a medium-term uptrend. As a look at Tesla, still tracking sideways. And once again, Google Alphabet looking the best, breaking out to new all-time highs. And just looking across other chip stocks like ARM, Supermicro, there's AMD, Broadcom pulling back, and Taiwan Semi still holding up there. There's the BlackRock Barometer tracking sideways, consolidating now this entire year. Alright guys, there we have it for this quiet Tuesday session. Pretty low range there in the S&P 500. Volatility super low. Bond yields, gold tracking sideways. Nvidia bouncing back a little bit. Market seems pretty sleepy here. Could be going into a quiet summer of trading. However, like I said, the market's still a little stretched, looking at seasonalities. Other than that, this grinding higher, short, medium-term trend still seems to be intact for now. That's all I got for you today. Thanks very much for tuning in. I'm always interested to hear your thoughts, so you're welcome to post a comment below this video. And as usual, I'll be back tomorrow night to break down all events for you again. Thanks very much, and see you then. Cheers.